Hello and welcome to Financial Summaries. Today we are decoding ICICI Bank's fourth quarter FY 2025 earnings call. Let us break it down in simple terms. ICICI Bank closed FY25 on strong note, with net profit rising at 18% YOY to 12,630 crores in Q4. For the full year, profit grew by 15.5%, a solid performance in a year marked by global uncertainties and shifting interest rate. Let us start with core engine. Net interest income rose by 11% year over year to 21,193 crores. The net interest margin or NIM, which is the difference between lending rate and deposit rate, came in at 4.41%, up from 4.25% last quarter. So what drove this improvement? Management explained that the jump was due to date count effect or and cash reserve ratio reduction in Q3 and interest on tax refunds, while acknowledging that repo rate cuts and rising cost of funds were partial offset. Management was also clear that margin may moderate in future with more rate cuts expected. Moving to loan book trends. Business banking portfolio grew by 34% year over year. Overall domestic loan growth stood at 13.9%, with retail loan growth slowed to 8.9%. Within retail, personal loans were up just 4.2%, while credit cards saw a growth of 11.7%. Rural loans grew by modest of 5.1% and actually declined sequentially. The bank emphasized its risk-calibrated growth strategy and particularly in unsecured segment. Management mentioned, we do not chase growth for its own sake. Our focus remains on return of capital and customer quality. Asset quality was a clear positive. Net NPA came down to 0.39%, which is very good. Gross slippage were at 5,142 crores, while recovery and upgrades were robust at 3,870 crores. Provisioning coverage stood at 76.2%. Deposit growth and CASA concerns. Deposit grew at 14% year over year. However, the CASA ratio, a key low funding metric, fell to 38.4%. Some analysts voiced their concerns about shift in saving rates, which were reduced to 2.7% recently, especially as liquid fund offer better returns. Management said, we are not chasing CASA in isolation. Our goal is total customer wallet share, whether current accounts, saving accounts, or term. Digital and technological investment. ICICI Bank is continue its push on technology. About 10.7% of operational expenses were towards tech. The bank is focused on simplifying operations and improving digital alliance. Coming to the key questions from the analyst, one analyst asked why retail loan growth had deaccelerated. Management clarified it was intentional. We slowed unsecured credit growth as a precaution. Growth dropped from 32.5% to 4.2% in personal loans, but the portfolio is now stabilizing. Another analyst pointed out that corporate loan growth outpaced the retail. Management clarified this was due to system level opportunities and not structural shift. When asked what the impact of trade wars and global volatility, management remained cautious, stating that we stay nimble, watch risk closely, but also look for emerging opportunities. To sum up the call, the positives were profit after tax up 18% year over year, net interest margin improved sequentially to 4.41%, stable asset quality with net NPA at 0.39%, sensible growth in risky segment, and capital adequacy ratio stood at 16.5%, pointing to strong financial health and ability to expand lending. Management also recommended a dividend of 11 rupees per share. While concerns remain mainly around CASA pressure that could impact margin, slower retail momentum may cap near-term growth, repo rate cuts could compress margin further. The key takeaways, ICICI Bank is staying in the course with cautious, high quality growth strategy. It is managing risk well, keeping cost in check, and delivering solid returns. But margin compression and slowing unsecured retail growth are the key metric to watch in FY26. Thank you for watching. If you found this helpful, do consider liking, subscribing to Financial Summaries, and commenting below with which banks you will like to cover us next. Thank you.